Good evening, everyone. I welcome you all on behalf of Dadri City Study Circle to the today's seminar on recent amendments in the auditor's report and CARO. We all are aware that there are drastic changes in reporting for FY22. So, what care we should take and what we might be having many queries in our mind. So, we have with us eminent speaker CA Timal Maru, who will be guiding us through the process. Before we start, I request Parin to play ICI anthem.
येष सुप्तेषु जाग्रति येष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्द्वैता 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 एतद्द्वैता.
Thank you, Parin. Now I request our member CA Meghna Makra to introduce today's speaker.
Good evening, everyone. It gives me immense pleasure to introduce CA Timal Maru on behalf of Dadari CP Study Circle. I welcome him. CA Timal Maru is a fellow member of the institute, and he is a practicing chartered accountant and has more than 23 years of experience. He is a partner in Messrs. Sridhar and Associates Chartered Accountants, having office at Mumbai and branches at Delhi and Bangalore. Sridhar and Associates is also having associate offices in the foreign countries of USA, UK, Singapore, Mauritius, UAE, and Hong Kong. He is also a partner at Messrs. JMMK and Company Chartered Accountants, having office at Mumbai and branches at Kota and Bhopal. CA Timal Maru has done a certification course in AS conducted by the institute. He has experience of handling statutory audits under Indian IFRS, UK, as well as EU GAAPs. He has also carried out Ind AS conversion assignments and has a vast exposure of auditing companies under Insolvency and Bankruptcy Code. He has handled several assignments relating to statutory internal management audits of listed, unlisted, as well as mid-sized corporates. He has also conducted audits for branches and central audit of nationalized and cooperative bank, and also conducted concurrent audits of banks. He has done several assignments on valuation, due diligence, fraud investigations, SOPs, etc. Besides this, he also has experience in providing opinion on various accounting matters and company law related matters. He also possesses wide exposure in power and energy industry, print and electronic media, realty, NBFC banking, engineering, and other services. He has presented on the recent amendments in companies rules and companies auditors and audit rules applicable for FY 21-22 at the national program organized by Corporate Law and Corporate Governance Committee of ICAI and hosted by Navi Mumbai branch of WIRC of ICAI, at the program organized by Jain Chartered Accountants Federation. He was one of the contributors to the illustrative Ind AS financial statements publication issued by WIRC and anthology of In AS, notes and disclosures publication also issued by WIRC. He was co-opted member of IND AS committee, WIRC, and convener of WIRC IND AS study group for the year 2019 to 2020. With this brief introduction, I welcome CA Timal Maru, and I hand over to Pareen Gala to give him a vote of thanks. Thank you.
Thank you, Meghna. And now I request CA Pareen Gala to produce a certificate to Timal Bhai.
Thanks.
Thank you, Rahul. Timal Bhai, with this online hours sessions, and we thank you for accepting our request. This certificate is an appreciation from the other CP Study Circle to you for accepting our invitations. Please accept this.
Thanks, Prime. Accepted.
Timal Bhai, floor is yours.
Yeah, thanks. Parin, can you confirm the?
Yes, Timal Bhai, the screen is visible.
Thanks. So before I start, I should thanks Meghna for giving the wonderful introduction. I also thank Parin for interacting with me for this session. At the outset, as the convener of the study circle has said, there are the numerous changes which is brought by the regulator, and before discharging our attest function, we should be careful about what are the requirements and how we should take it forward. Now, today's session is, if you see overall, I will be covering the key amendments in relating to Companies Act rules, which is impacting for the financial year 21-22. Specifically, I will deal with the disclosure requirement and the reporting requirement by the auditor. Before going to the topic, there are certain things which has came in my mind where I thought I should share with the members. Now, the applicability of responding to the non-compliance with the laws and regulation, fees, and other related matters has been postponed from 1st April 2020 to the 30th September 2020. Once these things are implemented, we have to be very careful about the SA 250, which is applicable to all the audits. Further, in March 2022, the ministry has come out with the recommendation, and it is impacting the audit profession at a large. So we have to also be aware about what are the changes which are expected from the government, the regulator perspective. I would like to draw attention to all the members. There are the revised norms of the peer review, which is come by issued by the ICI. These rules norms are in addition to the SBI prescribed norms. If you able to download from the CA Institute and we'll go through it, if you will find it now the partners with more than 5 or more partners, 4 or more partners are required to do the peer review. And it will start in the phase manner from 2023 onwards. So we have to be very careful if you want to discharge our responsibility as auditor after 31st March 2023. Here I would like to draw your attention where our institute president, Mr. Debashish Mitra, has mentioned, audit is a serious business. Stay away from it if you can't meet the expectation gap. This is what, if you see in last couple of years, NAFRA is there, ED is there, everywhere the questions of audit is being questioned by all the authorities. So we have to be more clear about what we are doing. We need to be more clear about it. And further, as we see the changes which is expected by the Schedule 3 CARO requirement. So to deal with this, if members have any issues, the institute has come out, the Auditing and Assurance Standard Board has come out with the expert panel for addressing queries. This is a very welcome steps taken by the institute for addressing the queries of the members. Now, there will, I'm audible, na? Sorry?
Yes, yes,
Yes,
Timal.
yes.
Yeah, okay. Now there would be questions in the mind of the people, okay, why there are so many changes, whether in the CARO or the Schedule 3 or the main report. If you go a little bit background about it, you will find the NAFRA has issued some of the reports on some of the listed entities. Second, if you see the RBI is also given some sort of like summons for a particular auditing firms, they cannot carry out the audits. So if you, and secondly, the way in which the NPAs are increasing, all has forced the government to come out with the certain additional disclosures to give the transparency. So if you would talk about the transparency, if you see the way in which the loan within the group companies are moved, and ultimately it is moving to the entities where the director or promoter are interested. Secondly, if there has to be accountability. If you see in the past, there may be a certain clauses we used to report in the CARO, but there was no corresponding reporting in the schedule or the notes to accounts. Now, the amendment which is sought by the new order 2022, if you compare, there are certain clauses which are there in CARO 2022 also, on which the management has to give their assertion or explanation or disclosures in the financial statements. And definitely the early warning signs, if you see there are a large number of corporates which are going under the IPC or the NPA has risen compared with in the past. So, which has forced a number of which has forced the regulators to come out with a certain additional disclosures in the financial statement, which is common at a large. Now coming to our today's sessions, what we are going to cover is the key amendments in the Companies Act relating to account. There are certain changes in the definitions. How it is impacting, we will see in the subsequent slides. There is a change in the Companies Accounting Standard Rule 2021. Earlier it used to be a 2006 rules. Now by way of the 2021, it is superseded. We will see the key changes in the Schedule 3, key changes in the CARO, and if time permits, we will definitely touch upon the Companies Audit and Auditors Amendment Rule 2025. First, now in the Companies Act, there is a change in the definition of the listed entity. Earlier, all the securities which were listed on any recognized stock exchange were treated as the listed company. Now, by way of the notification dated 19 February 2021, the certain companies, date-listed companies, which are out of the purview of the listing criteria, but this scope out is from the Companies Act perspective, not from the SEBI's perspective. We'll see which are the companies. Public companies which have not listed their equity shares but have listed their non-convertible debt issued on a private placement basis, or a non-convertible redeemable preference shares issued on a private placement basis. So this is with respect to the public companies. With respect to private companies which have listed only their non-convertible debt security on a private placement basis. So all these companies will not be treated as a listed companies within the definition or within the purview of the Companies Act 2013. And one more, the changes which is brought is if the company is listing outside India, those companies would not be considered as the listed entity. So we'll see what is the implications. If you see implication perspective, the rotation of auditor will not be applicable since it is not since unlisted company, and internal audit internal financial control will not be applicable, less penalty compared to the listed entity. However, this company is still required to follow the quarterly results, audited financial result within the time frame of the 60 days from the year end, and other disclosure as required by the LODR. So, if you see at a larger perspective, only the companies which are listing outside India would be benefited out of these changes. Now, next changes which is brought in the definition is the definition of a small company. So, not a definition, I would say there is a threshold which has been changed. So, earlier the paid up capital was 50 lakhs, now which has been changed to a 2 crores. Now, turnover criteria has been changed from a 2 crores to 20 crores. So, if you see new threshold limit, there would be a number of companies which would come under the small company. As some reports were available during the discussion at the parliament, they says more than 2 lakhs company would be benefited because of the change in the threshold limit. So while discharging the audit function or at the end of the March 22, all the members are requested to please check the threshold limit, and if the company is coming under a small company, then there will be some relaxation from the regulatory perspective. So there is no change from the exclusion perspective, which was there earlier. Now it will remain the same. Only the benefit because of the change in the threshold limit would be once is the CARO would not be applicable, because earlier also CARO was not applicable, but because of change in threshold limit, more companies would come under the umbrella where CARO is not applicable. Now this is the change with respect to the IBC company. Now, additional disclosure required in the board report. Now, this is applicable from 1st April 2021. We'll see what are the disclosures. The details of application made or the proceedings pending under the insolvency and bankruptcy court during the year, along with their status at the end of the financial year. So, if companies under the IBC, then the statement has to be given in the board report. However, precautions. The auditor signing the balance should take care. This intimation, this requirement is applicable not at the year end, but till the time the reports are signed. Para 8.5.12 talks about the details of difference between the amount of valuation done at the time of one-time settlement and the valuation done while taking the loan from the banks and financial institution. So this is because if you see the way in which the resolutions are happening at the company which are under IBC, in most of the cases, if you see on an average 15% to a 30% the settlements are happening. So the regulator thought about what was the valuation done at the time when the company has taken a loan, and what was the valuation done at the time of the settlement. So that disclosure is required. Now, main problem is the applicability. Now, this notification talks about it is applicable with effect from 1st April 2021. It doesn't talk about it's applicable for a financial 21-22. If you see generally the IBC company, generally their financials are not on time. So possibly you may be signing the balance sheet of 19 or March 20 and issuing a report as on date after 1st April 21. So we have to check from the additional disclosure required because of the change in the or the news notifications. Now, if you see from the guidance note perspective, the default we are required to report on the defaults of all the lenders, which we'll discuss in the subsequent slides. However, in the director's report, the reporting is required only with respect to banks and financial institutions. So these are the additional standard on auditing which we should consider if we have such reportings. Maintenance of books of accounts, which is the lot of things discuss about the maintenance of the books of account. However, the applicability is different, so we will not discuss and spend much time here. This is a new clause which is introduced, which is with respect to the unlisted entities. If it is in line with the same what the listed entity is saying in the quarterly result. However, the section is not yet notified. So we'll see once the section is notified, what are the implications. CSR, I think. CSR also, if you see, there are changes with respect to the set of rules. If you have spent excess amount in the past, now by way of a changes in the notification brought by the notification, the company can set off the what amount spending, excess amount spent in the past against the current year's liability. So this will have the accounting treatment. So if we are using this set off, then to that extent, possibly the less provision will come. And secondly, in the current year, if we have spent more than what is required and our intention is to set off in the future, possibly we have to give the treatment with respect to the prepaid also. So these issues which we have discussed. It's just change in the number of days. Earlier from 15 days, now it is reduced to 7 days. This change is applicable to the NBFC and housing company. See, what was happening earlier, the special resolution was required to be filed with the ROC. Now the banking company were exempted from filing those the resolutions. Now, additionally, by way of this notification, NBFC housing finance companies are also not required to file the resolutions with the MC or the ROCs. This was the clause which was brought last year. It is just for the reference. I'm putting. It is not a new clause related to a 21-22, but it was issued in 18th March 2021. I thought to present before you. If you are giving any sort of remuneration to the non-executive director or independent director, earlier there was no, we were not able to give it. Now, in case of loss or inadequate profit, because of the changes brought by this notification dated 18 March 21, all these directors are entitled for the remuneration within the prescribed limits as per the Schedule 5. Now we'll discuss about the see the companies. The MC has come out with a notification with respect to the accounting standard applicable to 2021. Now, this notification or this accounting standard would be applicable in majority of cases where we are either company is small or it is applicable to a small or medium-sized practitioner where the company size is small. Just in a few slides, we will see what are the changes which is suggested, brought by these notifications. Now, it is applicable to every company other than the companies which is following the index. And one more important thing is that the auditor shall comply with the accounting standard. So we have to be more careful about when we are applying the company's accounting standard rule 2020. Which are the standard notified? If you see A's 1 to 5, 7, 9, 29. Earlier, we used to have the accounting standard 6, accounting standard 8, now which is related under this company's accounting standard rule. Accounting standard, the provision of accounting standard 6 with respect to the depreciation are merged with A's 10. So for March 22, if you are finalizing any balance sheet, please take care. In the financial statement, nowhere it is mentioned the depreciation is as per A6 or the employees benefit revised, because everything is, because of these changes, everything is got changed. So be careful about it. Now, because of the accounting standard rules, previously also there was the companies which are bifurcated either with SMC and non-SMC. Same conditions or same criteria is here. Now only the threshold limit has changed. If you see, there are overall 5 criteria were there with respect to a listing. First criteria, listing criteria, there is no change. Financial sector criteria, there is no change. With respect to a turnover criteria, there is a change in the threshold limit of the turnover. Which earlier, which was a 50 crore, now it has been revised to 250 crores. With respect to borrowing also, there is a change in threshold limit, which was earlier 10 crores, now which has bring to the 50 crores. So all companies which are satisfying all these 5 criteria can be treated as the SMC company. Now the company, see, for any company to take the benefit of SMC, so those companies should continue the SMC criteria for 2 consecutive accounting period. So suppose there is a company who was already our SMC company in March 21, say in the 2006 rules, and in 2022 also it is satisfying the criteria. Then in 22 they can continue. But there may be a number of companies, because of change in threshold limit, would come under the umbrella of a non-SMC company. But this seems to be the first year of a non-SMC. It would be difficult for them to treat the company as a non-SMC company. So SMC company, and you have to wait for 1 more year, say March 23, to take the benefit of the SMC criteria. With respect to the criteria, with respect to SMC to non-SMC, there is no change. What was there in earlier in 2006, it's still continuing. So there is no change. So whenever company is the qualifying as SMC company, they have to give the unreserved and explicit statement in the financial statement. It was there earlier also, and now also there is no change. So we'll see what are the summary of the standard which is impacted because of the change in the SMC definitions. AS3 would not be applicable. However, you have to see from the small company perspective, because the company is SMC, but other than small company, then cash flow would be applicable. So at a large, if you see, the standard comes under the 4 buckets. One is the index, which is applicable to a listed entities and the associate or subsidiaries of the and JVs of those listed entities. Accounting standard is bifurcated between the 2: a company which is SMC and other than SMC companies, and the ICI standard, which is applicable to non-corporate entities. Till this, any questions? Otherwise, we will move for the further. Okay.
I think we can move it.
We can move further, yeah. Because I want to take a pause, because there are different things which you are discussing. So one thing is over. So if any questions, we can take it forward. Otherwise, we'll move to the next topic. Yeah. Now, change in the Schedule 3C, which is the notification dated 24th March 21, has suggested a lot of changes in the disclosure requirement of Schedule 3, which will in subsequent slide, which we will discuss in detail. Change in CARO compared to the 2016 requirement, the number of clauses are increased. The reporting requirement has also increased. So we'll also discuss in the subsequent slide. And one more thing is that there is a change in the main audit report also. So if time permits, we will discuss in length at the end. Just for the information of the members, the Schedule 3 is divided between the Division 1, Division 2, and Division 3. So division is applicable where in case of the non-index companies are there, or the NBFC, which is a non-index companies. And under division 1, most of the companies are required to follow Companies Accounting Standard Rule 2020. Division 2 is the company who is following the following the index criteria, and accordingly the financials are required to be prepared under the index framework. Division 3 is specifically with respect to the NBFCs whose net worth is more than 250 crores, and they have to specifically follow the index criteria. Just for the sake of information, what is included in the financial statement? The balance from division 1 perspective, balance sheet, statement of profit and loss, cash flow statement. If you see, the cash flow statement is not part of the schedule 3. It is a part of the financial statement. That's why the company is required to prepare, and auditor is required to report on those cash flow statements. Same way, division 2 and division 3, the same required. If you see the balance sheet is there, statement SOC is there, statement of profit loss, and include the OCI or other components. So division 2 and division 3, if you see, same sort of the financial statement is required. Just tabulated what are the key changes. These key changes which we will be discussing individually in the subsequent slides. Caro, if you see overall perspective, there are 50 clauses, including clauses, sub-clauses. There are the 50 reporting requirement where either as an auditor, we have to give the objective, so it's a factual, and there are the 36 clauses where we have to be a judgmental. Yeah. So for the sake of credit, the discussion, I have bifurcated it, all my discussion between these 4 parts. There are the key changes in the schedule 3 and the relating changes reporting requirement in Caro. So when we are discussing, we'll be discussing both together. There are the key changes in schedule 3 and no corresponding changes in Caro. There are a separate slides which deals with the key changes in reporting requirement Caro and no corresponding changes in the schedule 3. And fourth one is key changes in the schedule 3 and related changes reporting requirement, and same way in the main report. So basic point for the caution is since the company is required to report in the financial statement, and auditor is also required to report on those facts. So please, as an auditor, we have to ensure that there is no material inconsistent between the financial statement disclosures and the reporting under Caro. Now, first point, with the property, plant and equipment disclosure with respect to the title deed of immovable property. Now, if we recollect in 2016, Caro 2016, we used to report only the title deed related disclosures with respect to the PPE only. Now the scope has been expanded. Now it talks about the details of all the immovable property, whether it's a PP, whether it's an investment property, whether it's a non-current assets held for sale or the other assets. See, all this disclosure is required in the schedule in the financial statements. We'll see what are the disclosures are required. So I already discussed the relevant line item in the balance sheet. Description of item of property means either land is there or building is there. Here we have to report only gross carrying value amount. Second, subsequently we have to report the title deed held in the name of whose name the title deeds are there. Whether the title deed holder is a promoter, director, relative or promoter, or director or employee of promoter. So regulator wants to know whether this property is in the name of the related party or not. Secondly, property held since when. So this is the also we have to go back to the since when the property is not held in the name of the company. Because earlier we used to give for the TPU, so possibly data would be available. However, in case of in other case, we have to find out and accordingly report in the Schedule 3 also and the CARO also. And in addition to that, we have to mention, the company is required to mention the reason for not being held in the name of the company. So you have to state the reason, and in such cases, if there is a dispute, then a reference of dispute should be mentioned here. Here, this is the reporting requirement by the CARO, whether the title deed all movable properties other than properties where the company is the lessee, and the lease agreements are duly executed in favor of the lease. This is the same requirement, which is a disclosure requirement by the companies, and accordingly reporting requirement by the auditor. And if the auditor finds a certain discrepancies, then the format is there. In the format, so in this format, we can report what are the discrepancies. Now let's discuss key considerations. Now, first questions come in the mind of people whether all the agreement is required to be registered or the unregistered documents can be accepted. So in case of the land building, it will be difficult to accept the unregistered document. Maybe we can say the company is in the process of filing registration, or the registration document is filed and some disputes are there. Otherwise, in no case, we should accept the non-registered agreements. Now, in the Schedule 3 and CARO, the additional disclosure is with respect to the lease property. So if you see a lease property where under the index, under index 116, the treatments are given. In case of non-index company also, there would be a lease property where the expenditure related to lease properties are debited to a profit and loss account. So in this reporting requirement, we have to also comment on the lease properties. Now, what will happen with when the agreements are expired? So it would be a factual statement. The agreement is expired, which should give in the disclosure by way for disclosure. When the company is in the lessee of immobile property and the lease agreement are not duly executed, so there would be a cases where the company is enjoying the property or is in the control of the property as a lessee, but the lease deeds are not executed. Still, reporting would come. The properties with the group company. So this is the we have to be very careful. If you see in the group companies, when the new companies are incorporated or the small companies are there, it's operating from the same premises. And if it is operating from the same premises, your manpower is there, your IT system is there, and everything is there. So we have to be careful when we are auditing such a company. And if you see the company has a manpower using the office space, but there is no P&L expenditure. So possibly we have to consider the reporting under this clause as the lease agreements are not executed. Now, in the disclosure requirement, they talks about the reporting requirement for the others. What constitutes the others? If you see, there would be a certain building because of the nature, it would have been classified as a plant and machinery. So the others would cover plant and machinery and buildings or a land which is part of the plant and machinery also. Immovable properties acquired against the recovery. So this is mostly applicable if you see the company who is, say, if you have a trade receivable, which is a secure trade receivable, and the company and your customer is not paid and you have taken the possession of the property. So your receivable is the secured receivable and you have taken the possessions. So till the time and you do not, as a company, do not want to transfer the property in their name. So in the balance sheet, it's a line in maybe somewhere. So those disclosure is also required. If you see specifically in case of the NBFC who are giving a loan, say HFC companies or NBFCs, who are acquiring those such type of immovable properties due to non-repayment of either interest or the principal. So they classify this sort of properties in the balance sheet, maybe under the current asset head. Those properties also will require the disclosure here. The immovable property presented in inventories. So guidance note has come to a rescue. In case of real estate company, if any immovable properties is part of the inventories, it should not be considered for the disclosure perspective and the reporting perspective. These are the common questions which we have faced in past also, where we are reporting for the under 2016, it remained the same. So in case of change in name of the company, reporting under this clause till the new name is updated. So it is the factual things which we have to report, and company has to disclose and auditor has to report. Now disclosure with respect to the revaluation of PP ROU by registered valuer. So division 1 and division 2 and 3. So division 1 talks about the PP. Division 2 and 3, in addition to PP, that talks about the ROU also. What is the requirement? Where the company has revalued this PP, the company shall disclose as to whether the revaluation is based on the valuation by registered values, a definition under Rule 2 of Companies Registered Valuation, the Rule 2017. If we recollect the section 247, which talks about the registered valuer, they have specified which type of category of the valuation will be done by who. So specifically, if we talk about the machinery, the machinery would be a separate registered valuer is there. For land, there is a separate registered valuer is there. And for the securities perspective also, there is a separate financial securities point of perspective, there are separate registered valuer there. So if the company has done any sort of revaluation, first, it has to be through a registered valuer only. Other than registered valuer, it is not acceptable. And if the company has carried such valuation other than registered valuation, then the facts need to be disclosed. In addition to the requirement of the revaluation to be done by the registered valuer, there is additional requirement with respect to the disclosure perspective. So this revaluation, if changes 10% or more in the aggregate of the net carrying value of each class of property and plant equipment, then again the disclosure is required. However, if we refer the accounting standard 10 or index 16, there threshold limit of 10% is not there. Even if it is less than 10%, the disclosure requirement is there. So people should not restrict themselves from the disclosure perspective with respect to a 10% here. In line with the PP, the valuation changes are also brought with respect to the intangible assets. So again, same thing, 10% criteria is applicable here also. However, while drafting the disclosure requirement, there was some errors, it seems to be. Which is the related depreciation and impairment losses shall be disclosed separately. So some sort of the word amortization is missing. But however, you can consider it as a typographical error, and accordingly, we should accept it. So this is the reporting requirement by the auditor. There are once the section 247 came in operational, there was some discussion. These valuations are required from the Companies Act perspective or at the index perspective, possibly. Because why we are discussing for index perspective, because there may be some companies who are following the fair value concepts. So under the fair value concept, only the valuations are required under the index, not under the Companies Act. So whether the company is required to take the valuations from the registered valuer only if you are doing for index. Second, whether the criteria of the registered valuer will come in picture only if the company is asking valuation by the external valuer, or in case if the company is doing the internal valuation, whether the valuation report by the registered valuer is required. So these are the certain gray areas which is still not clear. However, from avoiding any sort of the dispute with the regulatory, so whenever company is going for the revaluation, it should ensure it is done by the registered valuer. Now, in line with the PP and intangible, for the companies who are following the index, there is an additional requirement with respect to the investment property. So if we see generally, under index 40, investment properties require all entities to measure the fair value of investment property for the purpose of disclosure, even they are following the cost model. So this is the requirement of index 40, because index 40 doesn't allow the not fair value is the revaluation model. So whenever the company has an investment property, at the same time they have to disclose what is the fair value. So now this guidance, the schedule 3 required such fair value is also required to be done by the registered value. So earlier most of the company used to do on the basis of the ready reckoner rates and all these aspects. So all this will change, and if they are disclosing the fair value, it has to be done by the registered value. Details of Benami property. This is the totally a new clause which we till the time we are hearing a lot on the Benami property. Now the company, the schedule 3 requires the company to disclose where any proceeding has been initiated or pending against the company for holding any Benami property under the Benami Transaction Prohibition Act and rules made thereunder. The company shall disclose the following: details of such property, amount thereof, details of beneficiaries. If the property is in the books, then the reference to the items in the balance sheet. If the property is not in the books, it is more questionable. So how, as an auditor, you will identify if the property is not in the books and it's a Benami property? Then the fact shall be stated with reason. Where there are proceeding against the company under this law as abenter or transaction or as the transferor, then the details shall be provided. So same way, in Caro also we have to report on the Benami property, whether the companies are having any proceedings have been initiated or pending against the company for holding Benami property. So just I have highlighted what are the key considerations while discharging the function as an auditor. First, identified of Benami property, especially if the property are not in the reflected in the book. So we have to understand how we will identify. So there may be a certain procedure which we can adopt, maybe a review of the minutes of board of directors, audit committee, risk management. There may be a certain the security of the legal expenses may throw some light on it. Listing of pending litigation we generally take from the management, and by way of MR also we take it. Obtaining management representations, independent confirmation. If you have any doubts whether on the basis of your scrutiny of expenditure and review of board meeting, this comes under the Benami property, please write later to the Indian council who is handling the case and take the independent confirmations. Now, inventory disclosures. This disclosure is impacting in majority of the companies. So what it says, where the company has borrowing from the banks or financial institution on the basis of security of a current asset, it shall disclose whether the quarterly return or the statement of the current asset filed by the company with bank or financial institutions agreement with the books of account. If not, summary of reconciliation and reason thereof. And if there is, in case of the differences, the guidance notes provide a certain format in which the disclosure has to be made. Same way, in line of the disclosure, the auditor has to report whether during any point of time during the year the company has been sanctioned working capital limit in excess of 5 crores in aggregate from banks or security or financial institution on the basis of security of current asset. Whether the quarterly returns or statement filed by the company with such banks are in agreement. So it's going hand by hand what is disclosed in the financial statement and in the CARO. We'll see the difference. There are certain difference between what is disclosure is there and what is reporting requirement. So we have to the criteria of 5 crore is with respect to the limits of all the bank considering all together, not with respect to the individual bank. Second, it talks about the reporting requirement, talks about the sanction limit. It doesn't talk about the utilization limit. So possibly, say before March, end of the year, limit was sanction of 5 crore, but drawdown was say 1 crore. Still, as an auditor, we have to report in the CARO since the sanction limit is more than 5 crores. Here, both fund-based and non-fund-based amounts are aggregated to arrive at a figure of 5 crores. So there may be cases where your sanction limit is less than 5 crore, but due to some reason, because of a non-payment of the either installment or the interest, the outstanding limit exceed the 5 crores. So in such cases, the reporting would not be required. Now here, the important key is the reporting not required for unsecured loan on loan-based assets other than current asset. If you see the Schedule 3 and the CARO both talks about the requirement with respect to current asset. If I have taken any loan against my PPE or the investment property, the reporting would not come. So for the benefit of people, public at large, I have taken two practical issues which has come in my mind for the discussion purpose. Say as on 31st March of 21, financial were finalized in September 21 and certain that is a doubtful and written off. The company has already submitted stocks book statement for quarter ended March 21 and June, in which the above debtors were classified as a good debtor and were considered for a drawing power. For quarter ended June, debtors as per books accounts will not match with it, because once we go back, once the accounts are finalized in September and when we revisit the figures of June 21, the figures as per books and as per statement will not match. So in such case, what to do? So ideally, in such cases, management should give a disclosures. Okay, because of this reason, there is a deviation in the reporting. Issue 2, which we are all are facing, is the additional funding is availed by inflated figures or wrong aging, which are not matching with the books of account. So whether we have to see only the figure as per book should match, or we have to see what is gone on the statement. So if you see the statement which is submitted to bank has the good amount of disclosure, like the aging is there, the due from related parties are there. So whether we are required to check all these things? Answer is yes, because what is going to the going in the statement vis-a-vis what is there in books, we have to verify. And if you are come to a conclusion by way of the wrong aging analysis or the inflated debtors or the inflated stock, the company has availed the additional facility or additional drawing powers or additional facilities. So then we have to consider reporting under section 143.12 with respect to the fraud angle. So this will come. A lot of people are questioning is, suppose in June quarter the company has taken additional facility, but in subsequent quarter they are coming with the normal facility. Possibly you can just think about of the reporting, but there may be cases where in all the quarters the company has taken the additional facility. Possible the section 143.12 will trigger, and that is the intention of the regulator also. Wherever in cases where the borrower has taken additional facility, the company should disclose, and if the company failed to disclosure, auditor should take the responsibility of disclosing in the CARO. So it will have impact on governance issue, impact on IFC, and if the amount is material, then we should think about qualifying our report with respect to SA 705. Yeah. Additional yes.
Sorry. So there is a couple of questions related to inventory and schedule.
Yeah, we can take it.
Yeah. So with respect to inventory, in case of tallying inventory and debtors with the DP submitted to banks, is it required to get the DP statement directly from banks?
If it really speak, we want to, as we do a confirmation, so we should write to the banks. This is my client and he has submitted the statement with you. Kindly provide the copy of the statement to us. See, otherwise the questions will come, the what data which is submitted by company to our auditor, whether it's the same data which is submitted to a to the bank, the definitely questions will come. So as the audit procedure, definitely you should write to the bank asking for the details of the bank, the statement submitted by the bank, by the borrower.
And one question is whether all Schedule 3 changes applicable to Division 1 companies.
See, I will bifurcate. If we refer the notification of 24th March, it deals with the Division 1, Division 2, and Division 3. So whatever is applicable to a Division 1, it's applicable to all companies. Now, just to clarify the doubts in the minds of members, see, there is no, once the either the SMC company or the small company or the one-person companies, once they follow Division 1, they have to follow all the requirement of Division. There is no exemption which is given to such companies. Yeah, next. I hope
yes.
I replied.
Yes.
Timal bhai, with respect to the statements which we discuss about the submission at the level of the banks about the stock, debtors, etc. In case there is no further loan taken or excess benefits are being taken by the auditee party, what cognizance as an auditor one needs to take or care one needs to take, as well as what is the importance that when the auditee party says that it is submitted on estimated basis, and it is not requirement of the law that every month you have to ascertain the correct stock and the debtors, whether they are doubtful or not, etc. In those circumstances, whether that estimated debtors or the stock statements which is submitted to the banks, what care as an auditor needs to be taken, and what are the legal consequences of that?
See, simply, I think this is the questions of all the borrowers, whether it's a small borrower or a large borrower. Now, see, in case of the listed entity, we are doing the valuations and the valuations are checked and inventory verifications are done. So from the listed entity perspective, we are not facing a much issue. Now, coming to an unlisted entity, generally they don't maintain. Now, it would be very difficult to say, I have filed on the basis of estimation. So in such cases, I request you disclose if variation is in the range of 1%, 2%, 5%, disclose and come out of the disclosure requirement. Because this notification was there in 24th March 2021. So all companies were required to follow. So they cannot say nothing was, there was no requirement to value or the properly. I hope I'm able to clarify your doubt, Mendra bhai.
See, basically, question arises when there is no extra benefit taken, or there is no motive of offending or taking any benefit of extra loan or cheating with the banks or something like that. In such circumstances, on the prudence manner and looking at the size of the businessman or the auditee party, whether any stand can be taken that these are is there any, first of all I wanted to know, but is there any compulsory requirement that you have to value your stock or debtors every month for the submission to the banks, and you have to maintain that, and you have to be very accurate in that. Or as you said, there may be a differences of 1 to 5%, and you write down in the disclosure part, and you get rid of the disclosure requirement. How far this will be a practical, and what you foresee that in such cases the bankers or the institute level to the members who is attesting this type of the reports, what you foresee that legal consequences may flow if there is something.
If you see a major changes which has come with by way of a disclosures in the Schedule 3 or Caro perspective. If I have to say in one point or in one sentence, this is the requirement of the banker. Okay, so whether you talk about the inventory, whether you talk about the end use utilization of fund or the diversion of fund, it is all ratios all from bankers' perspective. Now, once we understand this is what the regulator want us, because there are the cases now. Once we say, instead of say 100 crore stock, I have given this the stock statement of 120 crores. So it will be difficult to say the company has not benefited. And possibly at the end of the year, the limit would be within the 100 crores, but still the company has utilized this 20 crores. So practically, what is happening in what I have seen in my cases also, we are just giving the disclosures. The deviation is in the range of 5 to 10% wherever it is, and we are giving the reason. And in the reason we are mentioning, the company has not done the valuations, because in most of the cases, there was a difference or due to valuations.
Right.
So you point out, okay, this 5% or 10% variation is due to valuation, because what will happen if something happened with that company and your work paper comes under the NFRA or the other regulatory requirement, then it will be very difficult from auditor perspective to safeguard. So this is not the case where you can just say, okay, you can take the help, as we generally do. We want to protect our client. So here, definitely first we have to protect ourselves.
Correct. And just to update, from last year, if you see that the institute has already made this compulsory certain accounting standards for even the level 4 also, and for all such SMEs and small and medium even businessmen who are under the attestation functions, they needs to take care of this all accounting standards as well. So that is where the real challenge comes. Most of the listed and all, they may be maintaining, I know, but the SMEs or the small businessmen may not be able to comply with all this. And the real challenge to the attesting personality would be in case of SMEs.
Definitely, 100%. Agreed. Can I take it forward?
Yes.
Certainly. Thank you, Timal.
So now additional disclosure requirement which comes from the loans and advances, because if you see loans, the NFRA reports, which is available in the public domain, loans and advances to the related party was the key of siphoning the funds. So the regulator wants to come with the strict disclosure requirements. So we'll discuss what is the additional disclosure requirement under Schedule 3. The following disclosure shall be made available when the loans or advances in the nature of loans are granted to a promoter, director, KMP, and related parties. Specifically, either generally. What is requirement is, so in case of repayable on demand or without specifying any terms of repayment. So here, if you see those who are doing the banking audits, so bank normally would have seen there would be a cases where, not in a banking company, in case of a normal company, if you refer the Caro reporting of the most of the companies, some of the companies where they say where the terms of repayment or is not specified. So or the regulator wants to tightening those things. So why the terms of repayments are not specified. If it is repayable on demand, then you disclose how much you have given to the promoter, director, KMP. Because what is happening, if you see some of the balance sheets, the repayable on demand is continuous repayable on demand from last 10 years, 20 years. So, and the company is going in facing the financial crunches. But if you see a loan side, asset side, the amount is receivable on demand. So this is creating some sort of problems in the regulator's mind. How it is possible once you say amount is recoverable on demand and you are not recovering and you are unable to pay, and or there is a delay in payments. Second terms comes with respect to the loan which is taken without specifying the terms or period of repayment. So there may be a cases where either interest is not specific, interest terms are not specified, or there may be a cases where secured, unsecured portion is not mentioned. So it can be anything. So what is without specifying the terms of period of repayment is not specified anywhere. But however, you have to take a general meaning. You say there has to be a agreement where what as a layman, what we expect, those terms should come. Now, problem comes if this is the disclosure requirement by the Schedule 3. The questions come whether the amount repayable on demand or the without specifying has to be disclosed separately, or we have to combine together. Prudence view would the Schedule 3 doesn't talks about the separate disclosure, but the prudent view would be you should disclose it separately. And companies should understand, once we say without specifying any terms or period of repayment, we have to understand whether with the provision with respect to the related parties are complied or not. One more point which I would like to draw your attention with respect to the index company. Possibly once we say without specifying any terms of repayment, say a zero rate of interest, it has the accounting implication maybe from amortized cost perspective also. So we have to check those angles also. Whether the company is granted, so this is the reporting requirement by Maru. Whether the company is granted any loans or advance in the nature of loans, either repayable on demand or without specific, it's going in this same line. Only the precaution we have to be very careful is the definition of promoter, director, KMP, and related party as per the Companies Act. We should not stretch the definition to the index. Second, those companies which are following the index, say amortized cost method, say my 100 crore loan which is given at the zero rate of interest, in the buy of amortized cost, possibly the loan balance would be say 90 crores. So whether here we should disclose the 90 crores or 100 crores. So here they are from regulatory perspective, they are very clear. They're saying the reporting is from the company's perspective. So here you have to report 100 crores. So in the back of in your working paper, the auditor should have the reconciliation between a 90 crore and 100 crores. This will create additional work for the auditor. Now, again, in addition to this, what we discussed, the aggregate amount of during the year and balance outstanding at the balance sheet is required to be disclosed with respect to such loans or advances and or guarantees or security given to the joint venture and subsidiary joint venture and associates. This is the reporting which is given by the ICI guidance notes. So here what we have to report the aggregate amount granted. So say for example, H holding company has given say 100 crore loan to the S Limited on the 1st May 2021, which was repaid before the year end. Questions will come whether such 100 crores outflow from the holding company to subsidiary company will require a disclosure, because at the end of the year there is no outstanding. If you see the wording, the disclosure wording is the aggregate amount. So whatever outflow is there, it's required to be disclosed. This is what we discussed. The subsidiary and associate should be with respect to Companies Act, not accounting standard. The key challenge would be the understanding or identifying what are the advances in the nature of loan. So guidance note has given some sort of the thoughts and given some sort of clarifications. It is on how you can consider the advance in the nature of loan as it's part of the loan. So advance given for an amount in excess of order value. There may be advance against purchase order in accordance with the trade practice. So if trade practice says a 6-month advance is there, but you are given advance for 9 months. So possibly those will come under the purview of the advance in the nature of. Additional, one more additional reporting requirement on the clause 3, subclause E is the whether any loan or advances in the nature of loan granted which has fallen due during the year and has been renewed or extended, or fresh loan granted to settle the overdues of existing loan. So it is as good as in from the banking perspective, we say it's evergreening of loan. So such evergreening is done by the company, then the disclosure is required. Now this disclosure is not restricted to only a related party. Even if the loans are given to the non-related parties also, still the disclosure is given, required. Only the good thing is there, this clause 3 is not applicable to the companies whose principal business is to give loans. So housing finance company or the NBFC whose main business is to give loan. For those companies, the reporting requirement is not there. The guidance note has suggested some format also in which if you identified any such disclosures, how you can disclose. Compliance with the number of layers of company, it was there earlier also and now also there. But there is a specific requirement is whether the company has not complied with the number of layers prescribed under clause 287. Then a disclosure. It was not earlier. Earlier we used to cover this the 2-layer requirement under CARO under section 185. This is the reporting requirement in case of the non-compliance with section 185, 186, whether there are more than 1 layer of company loan given guarantees a security provider acquisition of security exceed the limits, loan given at a rate of interest lower than the prescribed, any other defaults. So the guidance note had given the format in which you can, if you identify as auditor, there are non-compliances, you can utilize this format. Borrowing. Now, this is the additional disclosure which is there in the financial statement, where the company has not used the borrowing from banks and financial institutions for the specific purpose for which it has taken at the balance sheet date. The company shall disclose the detail of where they have been used. So it is the earlier what was happening. If you see the CARO 2013, it was not there in 2016. Where the funds, where short-term funds are used for long-term funds are used for short-term, or we have taken for X purpose and spent for the Y purpose. Now the company is required to disclose, and at the same time, there may be a genuine cases where we say a company has say drawdown on say 30th March or 31st March, but the utilization is in subsequent year. So in such cases, if those drawdown, if it temporarily park in the current account or the fixed deposit account, then you should disclose temporarily it is parked. Now, what is the reporting requirement? Clause 9C, whether the term loan were applied for the purpose for which the loans were obtained, if not, the amount of loans were diverted. So here, our report, if we identify, I have taken a loan for a working capital and I have utilized for the creation of fixed asset or vice versa, the reporting is required. Maybe I have taken a loan from the working capital and it is diverted by way of the loans to a group company. Again, the disclosure is required. Not disclosure, it's a reporting is required. We discussed whether the fund raised on short-term basis have been utilized for long-term perspective, which was not there in 16, which has come back from the banker's perspective, as we discussed a few minutes back. Whether the company has taken any fund from any entity or person on account of or to meet obligation. This is the additional disclosures which we have to report. So if you see if the company has taken a loan to meet the obligations of subsidiary, associate, on joint venture. So we have to report it again. Now, if you see overall, the way in which the reporting required, earlier we used to follow the rules and regulations from principle-based perspective. Now, the Schedule 3 or CARO require detailing. So if you have done X, you disclose it. If you have done Y, you disclose it. So again, same way definition of subsidiaries is as per the Companies Act. I am not repeating what we have discussed again. Now, earlier slide was with respect to the actual loan taken, and in this case, where the company has raised a loan during the year on pledge of securities held in subsidiaries. So even if by way of a pledge also, if we raise the money, the auditor is required to disclose. If you say such reporting requirement is not there in the Schedule 3, but Schedule 3 talks about in general, if you are not taken for particular purpose, then you disclose it. Now come to a willful defaulter. This is the additional requirement from the company's perspective, where in any case where the company is declared as a willful defaulter by a bank or financial institution or the lender, the following is the disclosures. Now, question comes. Same way, we'll discuss on the questions. Reporting requirement, where auditor is also required to report whether the company is declares a willful defaulter by any bank or financial institution or other lender. Now, questions will come: who is the other lenders? So, further reporting. While reporting, there may be certain issues. The willful defaulter declared by the company, by the banks or financial institution, is up to date of up to the date of 31st March only should be considered, or till the date of issuing the report. So if you see unlisted entities or the private limited companies, they have to consider, say they are issuing their reports in the month of August. So possibly you have to understand, or we have to whether the company is declared as a willful defaulter to August. And if declared as a willful defaulter, then disclosures will come. Now, one more thing which would like to draw your attention: with the willful defaulter, IBC may come in picture. So we have to be very careful about the assessment of the going concern, which we'll be discussing in the subsequent slides also. But I'm drawing your attention: once the willful defaulter comes, please raise your eyebrows and understand what should be the additional reporting or the standard on auditing requires us to do. Even the guidance notes talks about the company has not been declared as a willful defaulter but has received show cause notice in accordance with RBI. Even show cause notice is required to be disclosed. This is sort of from the company's perspective. Once the willful defaulter comes, as I discussed, the impairment, change in fair value of financial asset, liability, credit risk, liquidity risk, going concern, everything will come in picture. Undisclosed income. And this is the hot topic. Whether the company shall give details of any transaction not recorded in the books of account that has been surrendered or disclosed as income during the year in the tax assessment and the income tax, such as search survey. The disclosure is, and unless there is immunity from disclosure under scheme. Also state whether the previously unrecorded income and related assets have been properly recorded in the books of account during the year. So this is some sort of the additional burden on the company also, because the auditor also, they have to thoroughly go through the assessment orders to understand whether the surrender or any income is surrender or disclosure is there or not. The details that are required to be provided by the company as part disclosures are, this is the provided by the guidance note. We can take the help of the guidance note or the formats. In case of company is not recorded, disclosed income in the books of account financial is applicable reason for the same should be disclosed. In same line of the disclosure, reporting requirement is there. Now, reporting requirement is with respect to the income tax, whether the previously unrecorded income has been properly recorded in the books of account during the year. Now, there are certain reporting consideration which we should keep in mind while verifying such a transactions. So, first thing is the events up to the date of approval financial statement should be considered for disclosure under this clause. Now, when we talk about the undisclosed income which is recorded, we have to understand from Ind AS perspective whether if amount is material, whether the restatement is required or not required. Now, it will question also on the IFCs also whether it is operating effectively or not. Any questions on this? Then we can discuss here only, because this seems to be a hot topic for everyone.
I think no questions yet.
No,
We may take up maybe collectively at the end. Also.
Okay.
Yeah.
Now, if you see the journey of CSR, earlier it was optional, subsequently compulsory. After the compulsory, now they are requiring us to transfer the unutilized funds on account of CSR to the respective bank account. So that has to be either within 30 days and within six months as required. So from CSR perspective, there is a disclosure. I think in past also we used to give the disclosure, but there is no uniformity because there was no format was given or the disclosure requirement was not given. Some of the companies were giving the disclosure, extensive disclosure. Some of the companies were giving only what was amount is required and how much they have paid. So now Schedule 3 has come up with the disclosure requirement. What company is required, minimum what company is required to disclose is the amount required spent by during the year, amount expenditure incurred, shortfall at the end of the year, shortfall total of a previous year shortfall, reason for shortfall. So you have to specify reason. Earlier the company used to specify the reason in the director report only. Now it is to be part of the notes to account also. Nature of CSR activities. So this will throw a light whether as per the requirement of schedule the expenditures are incurred or not. If such CSR expenditures wherever incurred and we have a transaction with the related parties, then again such transaction with RPT is required to be disclosed separately. And at the last, the movement in the provision is required to be disclosed. Now, in line with the disclosure requirement of Schedule 3, there is a reporting requirement by the auditor. The reporting requirement is bifurcated between two parts. One is the ongoing projects and unspent amount on ongoing projects, and one is the unspent amount other than ongoing projects. So it's only a statement of facts whether the company has complied with the requisite provision of the company side and accordingly transfer the amount within the specified bank accounts. So schedule guidance note talks about whenever you are transferring the unspent amount. So in both the cases, what should be the what and how you can disclose in the audit report. We'll discuss the ratios now. If you see, listed entities, debt listed entities were required to compulsory give the disclosure on the ratios while they're disclosing the financial result. However, there were no such a requirement on any other companies. However, maybe if you accept the disclosure requirement in the MDA sections where some of the ratios were discussed. Now, the regulator has come out with all the companies is required to disclose this in case of division and division 1 to all 11 ratios mandatorily. Second, division 3, there are some 4 ratios to be discussed. In addition to this, the company shall explain the items included in a numerator and denominator for computing the above ratio. So you have to disclose in the notes to accounts also what is my numerator and what is my denominator. Further explanations shall be provided for any change in the ratio by more than 25% as compared with the preceding years. So this activity we used to do by way of a SA 520 analytical procedure. We used to be part of our working paper. Now, extensive disclosure is required with respect to our ratios. Now, whenever we are disclosing these ratios, please be careful. There may be a good ratios, but company is unable to pay. So please take the assessment from the going concern perspective. One more important thing, there has to be a consistency in formula. Suppose Schedule 3 talks about wherever disclosures are done, we have to do a disclosure for the comparative periods also. Now, in 21, I would say the current ratio used to come, say 1.33. By using the same ratio, it is come down to 0.7%. So I do not have a levy to change the numerator or denominator, so that in the subsequent year I can get the better ratios. What is followed, which has to be considered, the ratio which is followed, numerator denominator, which has to be consistently followed. Now, on the basis of reporting, there is a the reporting requirement on the basis of the financial ratios, what we discussed, aging and expected date of realization of financial assets and payment of financial liabilities. The trade aging, trade payable and trade receivable aging we will discuss in subsequent slides. Other informations, the auditor knowledge of the board of director and management plans, whether the auditor is of the opinion that material uncertainty exists as on the date of audit report. So as an auditor, we have to play one more additional role of astrologer. Whether the auditor is of the opinion on the material uncertainty exists on the date of material, on the date of issue of the report, that the company is capable of meeting its liabilities existing at the date of balance sheet as and when fall due within a period of 1 year from the balance sheet date. So in addition to your auditing of the past historic data, we have to also try to understand what will be the future, and possibly we have to take some help of the astrology here also to understand whether what will happen after the 1 year. So till date, what we discuss is the whatever the changes in the Schedule 3 vis-a-vis the schedule, the CARO reporting requirement. Now we will discuss only the key changes in Schedule 3 and no corresponding changes in the CARO. Now, first thing is the mandatory rounding off. Now, this mandatory rounding off was there for the Schedule 2 and Schedule 3 companies. Now, Division 2 and Division 3 companies. Now, rounding off is mandatory for the Division 1 company. I think everybody would have heard about some ROC complaint that the auditor or company is taking the balance sheet from the direct tally and directly attaching. Those people who are doing this activity, please be careful. Now you cannot directly submit those financials without the rounding off. The rounding off criteria is mentioned here, where your income size is 100 crore or more and less than 100 crores. So criteria is there, but it's the humble submission to all. So even if the small company is there, say paid-up capital of 1 lakh, there are no transactions. So still you have to do a rounding off, and then only you have to submit with the ROCs. We'll discuss about the aging analysis of the capital work in progress and intangible assets under development, which was not there previously. Now, for all the capital work in progress or the intangible assets under development, the aging is required. The aging bucket is less than 1 year, 1 to 2 years, 2 to 3 years, more than 3 years. So this disclosure is with respect to project in progress, and the project which are temporarily suspended is required to be disclosed separately. Now, when we disclose here for the March 22, the Schedule 3 talks about the disclosure of the comparative figures. So the company has to do exercise to find out the figures of March 21 also. Now, one more, I think, from accounting the perspective, if we are auditing a company which has taken a borrowed fund, and the CWF is coming in the age of 1 to 2 to 3, please ensure the capitalization of interest from the age 16 and Index 23 perspective also. Now, earlier slide we were talking about all the projects. Now here, for the capital work in progress whose completion is overdue or has exceeded its cost compared to its original plan, following CWIP completion schedule is required. So wherever in case of the overdue projects, so disclosure is required project wise. So in earlier slide, there was all the projects were required to combine together. However, in case of overdue or which has exceeded its cost, the project wide disclosure is there. Same way, comparative is there. Now we discuss about what the challenges that the company is facing. See, this is the subsequent new requirement, and possibly our IT or ERP system is not able to generate such required data. Maybe a generating aging schedule may not come directly. Maintaining details of ongoing suspend details is required. Ongoing estimation versus of project cost versus the revision of estimation, because the project suspended details are required with respect to the original estimations. Actual cost versus budget. If IT system or ERP is not capable of doing it, then all this activity is initially we have to do a manually. Second, management has to perform the detailed assessment for overrun projects, suspended projects, because from the suspended project, from the impairment perspective, it has to be tested. The disclosure is required to present an asset project level except overdue project, I think, which we discussed, CWIP. Guidance note has clarified where the project is temporarily suspended at the end of the reporting period, but development of the same resume after the date of reporting period, then aging of it related to CWIP amount will be presented and the project temporarily suspended. Now, this is the one more additional thing which is not coming from the Schedule 3. The guidance note talks about the requirement mentioned about of aging will apply to investment and properties under development also. Now we'll discuss the aging of the trade payable. Now, till date, we never used to give the aging of the trade payable, but however, while doing the audit, it has to be part of the working file. Now, the Schedule 3 required the aging disclosures. So we'll understand what is the aging disclosure requirements are there. So it has come with the buckets like less than 1 year, 1 to 2 years, 2 to 3 years, more than 3 years. And at the same time, this aging the trade payable aging has to be bifurcated between MSME, others, disputed use of MSME, and disputed use of others. So we are from the overall trade payable, the company has to identify all these parameters and accordingly required to disclose. Now, one point which would like to stress upon is the aging comes only with respect to the amount which is due. So what a guidance note has suggested, now say I have a trade payable of say 100 crores. On the basis of aging analysis, on the basis of a due, the amount comes at 90 crores. So there will be a 10 crore amount which I have accounted in the books, but my due date is say in the month of April 2022 or May 22. So from the overall reconciliation perspective, we have to add one more column before the less than 1 year and bifurcate this 10 crore between MSME, others, disputed MSME, and disputed others, so that your figures in the notes and the aging analysis will match with the figures in the balance sheet. This is the some issues has come with respect to the aging talks about the disclosure of MSME. So it talks about all the three entities, micro, small, medium. However, if you see on the face of the balance sheet, the disclosure is required with respect to the micro and small. So to that extent, there will be a little bit deviation between it. If there are no party in medium party in MSME, then figure will match. Otherwise, the figure will not match. We'll discuss now. There are say trade payable in the range of 2 to 3 years and 3 years. Now, as a normal business or the normal understanding of the business, nobody would. Why the company has not paid it definitely is the issue. The question comes in the mind why the other party to whom amount is payable is not questioning. Why they are not asking the company to pay? If we find in aging any amount between 2 to 3 years, or maybe one depends on the facts and circumstances, we should start questioning on the authenticity of the transaction itself. Now, as people know, if the amount is not paid within 6 months to the creditors, the GST is required to be reversed. Now, by way of a disclosure, we are going to give the ready-made food for the GST officers. So be careful about the GST reversal. Now, what is a dispute? Now, I'm referring to the guidance note which is given. A dispute is a matter of facts and circumstances of the case. However, dispute means a disagreement between two parties demonstrated by some positive evidence. So, dispute doesn't mean everything has to be either in the court. There may be a letter saying we are disputing. So, in such cases, also the amount has to be reported under the disputed bucket. What we discuss about in the trade payable, same thing is applicable with respect to the trade receivable also. However, the only from aging perspective, in trade payable, we used to disclose from the less than 1 year. Here, less than 1 year is further bifurcated between the less than 1 month, less than 6 months, and 6 months to 1 year. So there are a separate disclosure with respect to a division 1, which is a non-index company, and division 2 and 3, which is a index company. So what is the reporting requirement? Say it's undisputed receivable, considered good, considered doubtful, disputed, considered good, considered doubtful. These are the disclosure in addition to what we are generally used to give. Now questions will come. Unbilled dues. There may be unbilled dues. So what we have discussed, if my unbilled dues is part of the trade receivable, on basis of aging, it will not match with my overall figures. So we have to separately disclose by way of a separate column, so that anybody reader of the financial statement can cross-tally it. From industry and the undisputed trade receivable is further bifurcated between the debtors which have significant increase in the credit risk, credit impaired. Both the disclosure required in case of the disputed trade receivable also. Regarding dispute, the same facts will come, or same understanding will come. What we discuss about the trade payables. Now, this is the additional disclosure with respect to the promoter shareholding. At present, we are in financial statement. The company is required to disclose with respect to the shareholding more than 5%. Now there is an additional reporting disclosure requirement by way of Schedule 3. And it is applicable to all the divisions. What are the amendments sought? We have to the company is required to specify the promoter name, number of shares held, percentage of total shares, percentage of change during the year. Details shall be given separately for each class of shares. So equity, preference, separate disclosure is required. Importantly, even if the promoter is holding less than 5%, still disclosure is required. SEBI LODR has, if you see a listed company, is required to disclose to the stock exchanges regarding the promoter and promoter group. However, in the Schedule 3, the disclosure is restricted to the extent of promoter and not a promoter group. Now, questions will come in the mind of people: who is the how to identify a promoter group? So section 2, subsection 69 of the Companies Act give the guidelines who can be treated as a promoter. First, who has been named as such in the prospect or is identified by the company in the annual return referred to in section 92. Who has control over the affairs of the company directly or indirectly, whether as a shareholder, directly or otherwise, in accordance with which direction. I think if you get the chance to refer the financials of the Infosys, if you see a Narayan Murthy is nowhere the part of the board of directors. But still, if you see as the board works under the advice of Mr. Narayan Murthy, that's why he is treated as the promoter. And these chartered accountants were just as providing a professional services to the management would not be covered as the part of the promoter. The reporting requirement comes once the condition of promoter is satisfied. Second, if they are holding any number of shares. If they are not holding equity shares or any other preference shares, then reporting is not required. We'll discuss. There's some presentation change from the schedule 3. Now this is applicable to division 1. Now property, plant, equipment has been reworded as a property, plant, equipment, and intangible assets. There is a separate disclosure for a lease liability. Earlier, it was part of the other liabilities. I'm skipping for that now. Current maturities of a long-term debt. Earlier, we used to disclose under the current liabilities. Under the current liabilities, separate disclosure used to be there. The current maturity is a long-term debt. Now, in division 1, it has to be part of the short-term borrowings. And accordingly, in division 2 or division 3, sorry, division 2, it's part of the financial liabilities and borrowings, and under that borrowing, we have to show separately. Implication, we have seen either doing a bank audit or while issuing some separate reports on the ratios. Since the current maturities of long-term debt was classified under current liability, it was missed from while calculating a borrowing limit. So if it is missed, please be careful. Now, since you are reclassifying the previous year figures, all your ratio will go on the toss, which is given to the banker. Same way, security deposit, some sort of the reporting changes is there. Now we'll discuss about the relationship with the stock of companies. Transaction of the companies. This is the additional disclosure which is there in the schedule 3. If the company has any transactions, then company is required to disclose a transaction with respect to investment in securities, receivable, payable, shares held by stock of companies, other outstanding companies. What is the disclosure requirement is the balance outstanding at the current periods and a relationship with stock of company, if any, maybe a related party or not. Key issue which is coming is the no doubt the changes has brought out by by notification dated 24th March 2021. However, it is difficult for any company on continuous basis to identify whether the transactions are done with the stock of companies or not. Definitely, now once the reporting requirement is there, disclosure requirement is there, the company should identify the system in which such data is captured. All are facing the issues with respect to the compilation of data, because if you see the data which is available on the ROCs, so we have around more than 24 ROCs, then all ROCs are declaring their list separately, and if you see there is no time, so overall compiled data is not available, so it is facing issues. Now, from reporting perspective, the issue which we are facing about the one is whether what are the stock of companies or not. Once you identify the stock of companies, the reporting requirement will come when it will come. Now, if you have done a transaction with X party, so at the date of transactions, it was not a stock of company, but balance are outstanding at the end of the year. So end of the year, the company was stock of companies. So such transactions are also required to be reported. Second, at the time of transaction of such company or with the stock of the company was struck off. But however, at the end of the year, there are no outstanding. Whether such transaction is also required disclosures. So there is no clarity about the disclosure. But however, on the stand which we in my opinion, personal opinion, even if you are transaction with the stock of companies, we have a transaction with a company which is not a stock of company, but at the end of the year, it's a stock of companies, then reporting is required. Small change with respect to the registration of charge and satisfaction of charge. So in case of the registration of charge and satisfaction of charge, the disclosure is required in case of it is beyond the time limits. However, the company shall provide the details in relation to each charge or satisfaction that are not registered by. So here, instead of compilations of data in individual cases, the disclosure is required. Cryptocurrencies, I think we'll skip because it is not applicable to the majority of the company, because in most of the cases it's done at the individual level. Compliance with the scheme of arrangement, still I think in nowadays most of the scheme of arrangement are in compliance with accounting standards, so I don't see any issues here. However, there may be old schemes which are still continuing, or their balances are carried forward. So from the profit and loss perspective, there is only a small change in their division 1 and 2. There is additional disclosure is with respect to grant or donation received in case of the Section 8 companies. Parin bhai, can we go further, because one part is remaining?
Yes, we can continue.
Now this section will not take much more time, because this key change is only the in Caro reporting. Maybe a new clauses or amended in existing clauses. So earlier we used to report the managerial remuneration aspect in Caro also, and a main report also. So there was a duplications. So welcome changes brought by the Caro 2020. Now we are not required to report in the Caro. Now, additional clauses, new clauses come with respect to the internal audit. It was not there in 2016, which was there, I think, in old Caros, and even it was there in old Mau Caro also. So what is the reporting requirement? Whether the company has an internal audit system commensurate with the size and nature of business. So we have to comment. So this is the judgmental call which we have to, as an auditor, we have to assert, give in the Caro. Second, whether the reports of the internal auditor of the period under audit were considered by the statement. This is the statement of the facts, whether we have considered all the reports. So wherever we are doing and the audit and under those entities, internal audit is applicable or done, please ensure that all the reports are available with the statutory audit before they sign up the report. Now, practically, we have seen in most of the big organizations, either a one-pager report or the executive summary or PPT presentation is given to the statutory audit report. Now, we should start demanding a full-fledged report and understanding what is the scope of the internal audit, what they have done, how they have done. So accordingly, we will be able to comment on whether the reports of the internal audit for the period under audit were considered by the statutory audit. So now fraud reporting, there is the expansion of the scope. Earlier, the reporting was required in case of fraud committed by officer or employees. Now this word has been deleted. So everything either by the company or on the company, if any frauds are there, so it's required to be reported here. Section 143.12, which we'll discuss in the subsequent slide also. I will discuss there. Whistleblower. This is the new requirement. It is there for the listed entities. For the unlisted company, it is new requirement. If any whistleblower complaints are there, then the auditor has to mention how he has dealt with while giving the opinion on the financial statement. Just background about the entities who are covered under the whistleblower is section 177 subsection 9 of the Companies Act is applicable. It talks about every listed company, companies which accept a deposit from public, companies which have borrowed money from banks and financial institutions in excess of 50 crore. So all these three entities are required under the Companies Act are required to have the whistleblower mechanism. And if any whistleblower mechanism is there, any complaints are received, so those complaints are to be handed over to the auditors to understand whether it has any financial implications. Nidhi company, I think no much changes. NBFC, just additional changes, whether the activity is carried out. So whether the company has conducted any NBFC or housing finance activities without a valid certification or registration is a factual thing. Second is with respect to any in NBFC only with respect to the core investment companies. So whether a company is a core investment company is a factual thing. Again, more than one CIC in the group, it's also a factual thing. Cash losses. Now earlier it was not there in 2016. Earlier we used to, before 2016 we used to report, but under 2016 the reporting requirement was not there. Now it has come back again. So in case of cash losses, so we have to report whether the in the current year, financial year, and immediate preceding financial, whether the company has any cash losses or not. Additional reporting requirement with respect to the resignation of statutory auditors. If you see in a couple of years back, there were a lot of resignation at either during end of the signing periods or during the last quarter. Now then, the regulator thought to bring this reporting requirement with respect to resignation of statutory. If you see, Maru 2020 was applicable for the March 20. Because of the lockdown or the COVID, the applicability was extended. So the name remained the change. However, we have to follow the Caro 220. We have to use the word Caro 2020. Now, with respect to the resignation of statutory auditor, some of the issues. Now, if you have been appointed as a new auditor, then the reporting requirement comes. Now, the question is coming when we are facing, so practically we are faced in case of the NBFC. Now, if you see the NBFC, because of the RBI requirement, there are certain because of the threshold limit of number of audits any firm can do. There was certain resignation from the previous auditor has resigned because of the RBI guidelines. So whether such thing also required to be reported. The answer is yes, because here they are not talking about the resignation of statutory auditor before the term or before it's applicable or giving any sort of exemption from the RBI perspective or any other perspective. So in all cases, we have to whenever the new auditors are appointed instead of an old auditor, the reporting will come. However, while reporting under this clause, we need to careful about this SEBI circulars, which is applicable to all listed entities and its material subsidiaries. There is a ICAI implementation line on resignation or withdrawal of auditors. With compliance with the appointment of formalities under the Companies Act and ICAI Code of Ethics required communication with retiring auditors. And why I'm specifying the compliance with the appointment formalities under Companies Act, because I have seen the lot of violations are there in case of IBC companies with respect to the appointment of the auditors. Now, this is the additional clause with respect to companies considered in consolidated financial statements. So if the entity is consolidating and it's a subsidiaries and JVs or the associates, are required to issue the separate report. In separate report, the component auditor is giving any sort of adverse remark, then the auditor of the holding company in the consolidated report has to give the reference. What is the reporting requirement? Whether there has been any qualification or adverse remark by the respective auditor in company's RO report of the companies included in consolidated finance statement. If yes, indicate the details of companies and paragraph number. So we are not required to reproduce what is there in the component auditor's report. Only we have to give the some mention about the para, name of the company and SIN number. So what is come in mind, we have to be very careful about the whatever reported by the component auditor should be reproduced here. It should be considered, because when we talk about the materiality at CFS level, it would be a different, and the materiality at the level of the component would be different. So we cannot apply for this reporting. Materiality at CFS cannot be applied for the reporting. Now, since it is a new requirement, so wherever we are auditing the consolidate, please ensure that in the group instruction, this requirement is covered. Practically, we face these challenges where the subsidiary or associate is, since it is not a listed entities, they have the time limit up to say September to finalize, say August to finalize the financials. So when we are finalizing the holding company or the financials of the report of the subsidiaries are not available. So in such cases, please draw the attention in the audit report, XYZ, the X subsidiaries, Y subsidiary, X associates, the reports are not available and not considered. There is a additional amendment in the existing clause with respect to the only the wording has changed, fixed asset to a property plant agreement. Now additional reporting is with respect to the intangible clause 1AB. We have to also talk about report about the maintenance of the records of the intangible assets. Third, and clause 1B talks about the again same thing, fixed asset has been changed from the changed to a PPE. So specifically, the requirement for the maintenance of the FAR, which is the normal word used with respect to the intangible, because intangible it's very difficult to maintain. There may be a challenge with respect to company made intangible assets. So it becomes very difficult to compile the data. However, I would try to give some sort of the key audit considerations with respect to how and what data we can rely. So in such cases, maybe a details of the payment method or capitalize on individual basis can be combined. So now earlier the physical verifications, we used to give the material report material discrepancies. Now the material discrepancy has been they have defined what is material discrepancy. So more than 10% is a material discrepancy with the individual line items. This is the cosmetic changes, so we'll not be discussing. In case of the disputed, earlier we used to hello, yeah. So in case of disputed, earlier our reporting was respect to the income tax, sales tax, service tax, and the custom duty. Now, what is covered under the clause A? In all such clauses, the disputed dues reporting requirement is covered. I would like to draw your attention to the default in repayment of loans. Earlier, the reporting was with respect to only financial institutions, bank, governments, and debenture holders. Now, this has been changed. Now, if there is a default to any lender, the reporting is required. Yeah. Praveen?
Yes, Timal.
Yeah. You can tell me
Girish bhai,
what
you
you
would like, yeah, Girish bhai, you would like to take up the questions? I'll take up the questions.
So I think for what of times, like what of time, I will not be able to cover this the reporting requirement. But just I would like to. So whenever we are issuing the audit report under section 143(3), so there is a two additional reporting requirement with clause E2 and E3, and one more reporting requirement with respect to a dividend paid or declared. So we have to be careful once we are, because I have in the public domain, I have seen one report where the reports are not issued as per the new requirement. Yeah. So from my side, I'm concluding. So any questions are there, we can take it up. See, one deals with the historic data. So in historic definition of budget. Yeah. So here we have to give only the historic data.
Okay.
Yeah.
So continuing to that, what audit procedure do you suggest to safeguard auditors' objective of asserting that figures?
Which figure? I'm sorry, I'm not getting.
Yeah, one. What audit procedure do you suggest to safeguard auditors' objective of asserting that figures are true and fair, other than obtaining the same in MR?
This question is with respect to CWIP or a
Yes,
general
yes,
question?
it is continuing to that question only.
Sorry, I think
This is
some
continuing
disturbance is
to
there.
the same question.
Timal bhai, it's related to CWIP.
Parin, can I ask that question? That question
Yes,
was from my
yes.
side.
Yes, please.
Good evening, Timal bhai. Harsh Nedia here. Hello. Am I audible?
Yes, Harsh, go on. Timal bhai, you just need to unmute yourself.
Yeah. Sir, regarding my question was regarding that the aging schedule of CWIP, where we have to give the aging schedule for prospective figures for 1 year to 3 year, 3 year to 5 year. That figures
Yeah.
are actually an estimated figures or budgeted
but
figures.
Not. It will go with your original budgets.
Okay. So, I mean, what audit procedures do you suggest? I mean, other than taking that in MR?
See, other than in MR, if in most of the cases, this sort of the project requires the board approval. So you can take the board resolutions to confirm the figures.
Okay, sir. Thank you.
Yeah. Yes, sir. Any other questions, sir?
Yeah, previous year ratio are also required to be
Yeah.
disclosed.
Yes.
So between.
So previous year go in hand. Whenever current year changes, previous year it's required to be disclosed.
So Manish Bhai was mentioning that my question was on aging of trade payables and receivable, whether for current year and or also previous year, which is new change in schedule 3. So he's mentioning that it is related to the aging of trade payables and trade receivable, whether we have to show for the current year and previous year also.
Yeah. Yes. Whether the aging is there, CWIP, intangible asset development, trade payable, trade receivable. In all the 4 cases, the comparative figures are required.
Okay. Dinesh Bhai want to know that he want that please show slides showing difference between division 1, 2 and 3. Just want to know what are the exact difference between small and SMC company.
1 minute. Should I go back to the presentation? No? 1 minute.
Yes, sir. Division between division 1, 2 and 3.
Screen is visible?
Yes, sir.
Yeah. See, this is the small company. I think threshold limit is 2 crore and 20 crores. That is from with respect to the small companies. Now, with respect to the SMC, turnover is from 200 crores. Earlier it was 50 crore, now it is 200 crore, and the borrowing is earlier was 10 crores, now 50 crores.
So ratios and all applicable to small companies also, what we are discussing.
Yeah. See, there is no once the schedule whether division 1, division 2, or division 3 applicable, then there is no some sort of relaxation or exemptions from the disclosure perspective. Whether it's a small company, 1% company, dormant company, so no exemptions.
Okay. Harsh Dedias has asked, in case of tallying inventory and debtors with the DP submitted to banks, is it required to get the DP statement directly from banks?
I think we have discussed.
Okay.
Preferably, you can ask as we send the year-end confirmation, you should also ask the banker to submit the stock statement, copy of stock statement which is submitted by the borrower.
So with this, I think so all questions which is available in the chat are completed. If still any members want to ask, either please share the question in the chat box, or you can raise the hand, so we'll take it up. We don't have much time. Within 2 to 3 minutes we can take up 1 or 2 question, if any. So
Mahendra Bhai has raised the hand.
Yeah, 1 minute.
Timal bhai,
Yes, sir.
In cases where the advances are being said to be loans or for whatever reasons, in that case, whether the cognizance of 185, 186, the rate of interest, whether it is prejudicial to the interest of the company or not, all these needs to be reported in that case.
Definitely, sir. Once we say it's the loans advances in the nature of loan, everything will follow 185, 186, 188, 189. Even you have to see the reporting under section 143(1) also.
Because at the time of the advances, these all considerations might have not been considered.
I think there is a change in the little bit facts. I think if the advances are given with the intention of loan, now there may be a practical cases. Say you have given the advances for the procurement of the services or sorry, procurement of goods. Now, because of XYZ reason, you are not able to get it. Then you have to demonstrate why we are not getting those goods. So here the original intention is to give the loan.
Okay. Okay.
Thank you, Timal bhai. I think now all questions and everything is been answered. I take up a very well deserved vote of thanks.
Before you take a vote of thanks, just I sincerely thanks all my Dada CP study circle for giving me the opportunity to present in my home ground. Thanks to everyone.
It's really nice to hear you. Thank you for accepting our invitation. It is really a right time to have the more clarity on the subject. You had explained very well in your lucid manner. Thank you for presenting and making it available for this session. I, on behalf of Dadri CP Study Circle, propose very well deserved vote of thanks to Timal Maru. I request all the members present give a virtual round of applause to Timal bhai. And there are many comments is mentioned here. It is excellent session by Timal bhai. Good presentation. Thank you, Timal bhai. With this, I am ending this session. Thank you very much.
Thank you very much.
Thank you, Timal bhai. Thanks.
Thanks, Mahendra bhai. Thanks.